Happy New Year, Drew.
Happy New Year to you.
So this is the first of our monthly updates, filmed rather than written. I think it'll be a great innovation for our business. Quicker information, clients get to understand what we're thinking when we're thinking. So we'll cover 5 main points: market update, model portfolio, our own model portfolio, who we met in the last month, some basic investment concepts that people have asked us to explain further, and 2 topics of interest.
We'll try and welcome some Q&A if people, clients and other people reading the newsletter want to send through Q&A different months.
Just email us to you or I, and we'll bring them on this podcast every month, and we can try to answer them. A lot of them are similar. If you think about the questions you get through the month,
Definitely.
we can put them all together and answer a lot of them.
As well, we're sending our quarterly reviews out in the next week or so, and that naturally brings up questions about what different investments are doing, why we're recommending changes, and the sort of changes we're recommending. So,
sure, sounds great. So first one, market update. What are the 5 key kind of events, or what did you see in the last month? I suppose that's the month of December.
Rate hikes. It's been a long year for investors, I think, when it comes to rate hikes.
Didn't stop, did it?
Yeah, I think what is the Aussie cash rate was increased another 25 basis points. A lot of economists were predicting 50 or 0.5%.
Yep.
But we're up to 3.1% now, and the US did something similar.
50, I think, did it?
Yeah, another 50 in the US, but many had predicted 75.
All with the attempt at trying to slow inflation. Is that how you see rate increases?
That's what they say they're trying to do.
Yeah.
Essentially, central banks and governments are trying to reduce demand. I mean, we can tell from what happened in Ukraine, what's been happening with supply chains. A lot of the challenge was supply side driven, and central banks can only control what's happening on demand side. So they're essentially trying to push demand lower and release that inflationary impulse or threat.
Sure.
Is it working?
Yeah. Well, I'm not sure it is.
Not sure.
Not yet. Retail sales seems to be still relatively strong.
Yeah. And inflation rates are rolling over.
Yep.
So the question I've got is, have we passed peak rate hikes? Are most of them beyond us?
Maybe the question is, have we reached peak inflation versus rate hikes? Because we know most reserve banks go over.
Always wrong. And there's a delay, like 6 months,
correct,
for any impact to be felt as well.
It feels like inflation is starting to get to the peak level, as you said, on the demand side and the supply side. But we'll see what the year brings.
And that was one of the other comments I had this month, was that the oil price, which has been a big part of energy prices, utilities, transport, is now back where it was before Ukraine.
Yep. It's a good example. Even shipping containers. Shipping containers got to basic shipping from China to Australia got to about $13,500. They're back down to about $2,000 per container. Probably long-term average sits at $1,500 or $1,600. So you can see some of those supply chain things have changed substantially.
And there's less written on the way down, isn't there? Obviously, it makes headlines when it's 13,000 a container.
Yeah.
And no one knows. It's the same as like lumber and housing construction.
Yep.
Timber, everything's kind of falling, or most things are falling significantly.
Of course.
Apart from rent.
Yep.
That seems to be the big pressure.
I think Asia was really interesting in that month. We saw a recovery of Asia, and quite a substantial recovery in Asia still in December. Contrast to what tech did. Tech had a good run the first 2 months of the quarter, and tech came off in December. So probably those 2 things for me, thinking about how do you position portfolios, where we position portfolios, and you're seeing Asia come back. And signs of China opening up.
Yep.
And then you've got tech. People want to invest in tech again. They're just not sure where and how.
Yeah. I think Asia was, definitely. I saw at some point the Hang Seng, so the Chinese index was up like 25% in a month. I think that might have been October, not December.
Yep.
And it's just people preempting, like markets always do, people preempting what's happening. So the government has started to release lockdowns. I think you had the first travel between mainland China and Hong Kong.
Yep.
Was that this week? All the attention was paid to kind of the political process and Xi Jinping becoming supreme leader or whatever, whatever that meant specifically, but the economy is, if you look at every other part of the world and over the last 2 years, every time the lockdowns and the restrictions finished, economies went incredibly strong.
And China's got an advantage over every other Western country because they do have levers and they can pull their levers whenever they want, right? And they're very good at pulling their levers.
And their interest rates are still, I think, still in the threes.
Yeah. So a bit of late thread around COVID at the end of the month. You saw some restriction of travel, so they've got a few issues around COVID, but all in all, maybe crypto was another one. If you think about themes, the fall and fall of crypto, you saw a lot of activity in December as well. That says, and that's really reset, and might have even affect tech, where people was resetting risk assets and how much appetite they have for risk assets. Crypto being probably the riskiest asset that people made a lot of money on, theoretical money in the last 3 years.
Definitely.
And now does that go to appetite to risk for other assets?
And you've had one of the biggest exchanges fall over, and then I think being indicted or arrested.
Well, it's funny, isn't it? Everyone wanted to invest into it because it was an unregulated market, but then when something collapses, they go, well, it should be regulated.
We want Fidelity or we want Vanguard to do it for us.
We want better regulation, but you're there because it's unregulated. So let's talk about our model portfolio and how that went in the month. And then I think probably good to recap for the year as well, because you've got a full calendar year.
Yeah, and all the benchmarks and index returns are coming out as well, so perfect timing for it. I mean, it was a pretty challenging month for most markets. I think you said October, November, where we started to see inflation fall off and expectations on rate hikes slow down. Tech and pretty much every global market was up October, November. That reversed in December. I think it was there seems to be mixed messages where the Fed will talk incredibly negatively and then act the opposite. So they're trying to push down animal spirits or the tendency to spend or the propensity to spend. And that's kind of what hit markets in December. There wasn't any specific data. Just another concern about what's going to happen in 2023.
Sure.
The result of that was, I think, most markets globally, Aussie outperformed again, down about 3.5%, so the ASX 200 for December. And then Dow Jones, NASDAQ down 6 to 8 to 9% in December, almost a repricing.
Sure. And you can see the Hang Seng went up. So, that probably follows those kind of themes we talked about.
Was it the only major global market that finished higher?
Yep, absolutely. I think our performance in our model went relatively well in the month. Over 12 months, our balanced growth portfolio, which is the portfolio that most clients go into, did negative 2.8. Aussie, if you think about how that went versus peers, everyone loves to compare portfolios to Aussie Super. Aussie Super did 4.6, but of course they have...
Minus 4.6.
Minus 4.6. They have a large portion of their assets in assets that aren't valued every day. They say they are, but essentially you need to take that in consideration.
Like
infrastructure, bridges,
private companies, venture capital,
and you can argue that that's the right approach. I'm not saying it's not a wrong approach, but when you're essentially,
I'll argue,
when you're comparing it apples to apples, then it's worth mentioning.
Well, there's usually a lag on those valuations in there, so it takes multiple quarters for valuations to fall in line with public or to catch up to public markets.
You can argue that all companies, both public and private, are priced the same, but the pricing mechanism of private is behind, and pricing of public markets is nearly forward-looking.
And some see it as a pro, some see it as a con of private markets.
I think when we talk about portfolio construction, that's just about timing. Is when do you buy public markets, when do you buy private markets?
And then Vanguard is always the traditional balance fund is usually a good comparison. That fell 11% for the 12-month period for the calendar year. So
that's all passive, all index. So if you were just the index, if you look, like the index versus us did negative 10.6, Vanguard did negative 11. Negative 11, if you think about difference, it's about 40 basis points. That's their fee. So that's all passive over a 12-month period.
And what do you think the two main reasons for the difference between our portfolio or our model and Vanguard performance?
I think it's a question probably for later, Drew, but I'll try to answer it now. Multiple things build sustainable long-term returns in portfolios. It starts at asset allocation. It goes to tactical. It goes to the will to rebalance at not just regular points, but at market corrections. And I think our firm is really, really good at making the hard calls.
At uncomfortable times.
Uncomfortable times, yep. And then it goes down to manager selection and manager options.
Yep.
And two things really, if you think about performance, two things that we probably got right were our duration calls. So we were all floating and we introduced some kind of duration back into our portfolios through the year. And we were probably less into global growth than a lot of the benchmarks.
The high growth kind of NASDAQ tech companies that did incredibly well in 2019, 2020.
And some really risky assets, and we didn't have VC, we didn't have crypto, so.
Yeah.
And, interestingly, the people still don't understand bonds. If you think about the most basic, perceived most basic concept in financial services, it's fixed income, right? Put money in term deposit. But no one really understands it.
It's a loan to a bank.
Yep.
Or a loan to any type of company.
Correct. I mean, we can try to explain it again. But, people don't essentially understand how a bond can get revalued.
Yeah.
They don't understand what duration is. They don't understand you should be, everyone now wants to be variable 100% in their portfolio where we're introducing fixed. And if you look at historical returns, then, of course, that's doesn't look like the best option. But the opportunity to make forward money is there if you add some duration to your portfolio. So I think we need to do some work to educate our clients and also our cohort that listen to us about what fixed income is and how to play it within a portfolio and what is its role within a 40-60 portfolio.
Yeah, because the majority of the biggest, so Vanguard's underperformance would have been because they held a lot of government bonds during the period, and because that's what the index or the benchmark is made up of, and they're all fixed rate bonds. So if you're in a fixed rate bond that's offering 3% and you can now get 3% in cash, naturally that bond's worth less than it was yesterday. And then hybrids would be the complete opposite, which we've used extensively, which are reset. Your interest is reset every quarter.
Yep.
And if interest rates are going up, your income's
You're
going
getting
up.
a high rate. So that 3% bond if I can get a 5% bond in the market, what I'm going to pay for you, what I'm going to pay for your 3% bond, substantially lower than the face value of $100. I'm going to pay you $90 or something. I'm actually going to pay you the price that gives me the 5% return I could get somewhere else.
And that's kind of that, not arbitrage, but just supply and demand.
And they're very powerful things, right?
Liquid markets.
In the last 10 years, holding duration, holding long-term bonds when rates went down, then you made a lot of money.
You had equity market returns for 5 years, holding duration, 8-9% per annum.
So
and they fell, on average, I think the Aussie government bond and the US government bond were down about 12 or 13%. So the lowest risk portion of most portfolios were down double digits in 2020.
Yeah. So I think 12 months, great returns, noting that you need to change portfolios to maintain your outperformance. So, the next 12 months, there will be some changes in our portfolios. We've talked about adding duration. What else do you see happening to portfolios, especially our kind of model, which you and I are accountable for?
Yeah.
What else do you see changing?
I think we're trying to find some more undervalued areas of the market and almost potentially a bit more focus on adjusting the focus to a bit more on cost. So you've had a period where active management has been important. When the index was at an all-time high a year and a half ago or 2 years ago, it was difficult to justify just buying the index at that point. So just buying the ASX or buying the NASDAQ kind of makes sense now. Yep. After the S&P is down 20%, the NASDAQ's down 30%, Australia's outperformed. So I think we feel more comfortable introducing some of the more passive or lower cost exposure to the benchmark, and then making sure that any groups that or any funds that we're recommending that are active are doing something significantly different or offering exposure to an asset class that's more difficult to replicate.
Sure.
I think would be the key. We're seeing value broadly in smaller companies, which we've probably shied away from on valuation concerns for the last 2 or 3 years.
Yep. But non-existent in our portfolios domestically, and we had
yeah.
some exposure globally. But.
And in given where most of the pain was in the ASX in the last 12 months was in the smaller companies, it kind of makes sense that they're more attractively valued now. That's probably where the big focus is. And then also, as you were mentioning, introducing some high quality fixed income again.
Yep.
So looking towards global duration. If you can get 3.5% by lending money to the US government, it's likely better than 3.5% on a fully franked dividend that could be cut next year.
Yep.
Depending on the company, obviously.
And generally, portfolios in Australia have done pretty well.
Yeah.
Our Aussie market is down substantially less than global markets. So then
5.5%.
If you think about our logic then is, well, we're probably not going to buy the large cap Aussie market that held us up. We're going to buy the small cap part of that market that fell away.
Yep.
And we're going to think about global and what is what is value now. The global growth drivers, company growth drivers, they're still the same. Their companies have fallen by a third or 2/3, some of them, but they're still very good companies to buy to add to your long-term portfolio in this kind of market.
And it's that rebalancing and finding real diversification, isn't it? Like some people would maybe just hold an index and think that's diversified, but you want multiple return drivers and economic drivers. So whether that comes from smaller companies that are in different sectors of the economy than what you can get, the ASX dominated by materials and financials, S&P is dominated by technology, or if it's regions and you're investing more in Asia, you're getting diverse range of economic and revenue drivers that'll help shield your portfolio during what's likely to be
It's portfolio construction 101, right? You're trying to find asset classes, sectors, stocks that have correlation that's different to each other.
Exactly.
So the trick to it is rebalancing. But rebalancing, we use the word rebalance because clients will listen to us if we rebalance. Essentially, rebalance is selling high and buying low. And it sounds so easy, but people won't do it. And you're seeing that by the number of questions that we get all the time about we should just be floating, not fixed. We should be, I want to sell my tech now. No, don't buy tech, buy more. I want to buy more of the Aussie market because it's done really well. Well, why?
And conditions have changed. Like a lot of interest rates drove a lot of returns in the last few years. So selling the things that did well or didn't do well is important, not to chase what's done well in 2022 and throw out what did well for the decade before. Getting the right balance. Right.
We're going to do some work this year about flows into managed funds and then the performance of those managed funds 12 and 3 years later. Because, if you think about flows, they typically follow the hottest spot, and the hottest spot is typically not the right place to be with the benefit of hindsight.
There's a couple of papers of major fund managers that show that the investors get a different return to the fund itself. Because when it performs well, more people go in. When it performs poorly, people go out.
There's tax ramifications too. So maybe we're going to do a whole series of educational podcasts throughout the year. So that'll be a good one to do a deep dive on.
Definitely.
Let's talk about who we met in the last month. It was a month of Christmas, so we met a lot of people informally, or rather than formally. But
so I had a good catch up with a guy called Andrew Swan who used to run BlackRock's Asian Tiger strategy.
Okay.
I think it was a $20 billion strategy at the time. He's recently launched with Man Investment. So Man is a massive global fund manager.
Yep.
GLG Asia Opportunities, so long only, which means it only buys, doesn't short any stocks, and just invests all across Asia. So India, China, Taiwan, Hong Kong, Indonesia.
Yep.
And he's having, I think, spent 20 years or so in the region, and all his work has shown that if you can find companies that are revising their earnings higher, particularly in Asia, share prices will respond to higher earnings or those that are about to turn around their earnings.
Yep.
He was quite what's the word, contrite when he said he has both a long short strategy or a hedge fund type strategy and a long only, and this fund hadn't been launched yet, so he was right to say. But he said, I wasn't really buying anything additional in China in the last 12 months.
Yep.
But is incredibly excited about the opportunities coming out this year, particularly with lockdowns and the stimulus that's coming from the government.
So a sector fund, a regional fund,
Yep.
active,
Yep.
and I met Andrew as well, and we really like his fund, fee appropriate as well.
Yep.
So he's doing all these things, picking a region, picking active stocks, and he's doing it at a reasonable fee.
And competitive cost, yeah.
Yep. So with a broad long-term history of managing money. So
Yeah. And part of that was us negotiating with him
yeah, sure.
and using our relationship with Atchison's to negotiate lower fees as well.
Yep. Great.
And you caught up with BetaShares?
Yeah, BetaShares. I mean, they're phenomenal, right? They've provided lots of options to mum and dad investors and to advisors to be sector specific investors. And I don't know how many funds they must have now, 60 or 70 different funds.
Yep.
And they've done something for the market, and that is create a lot of options for investors to invest. A bit like institutional investors, but through the ASX. So,
yeah.
Hats off to BetaShares and the other groups that have done that in Australia. The feedback we heard from them, which is interesting, and it comes back to what we were saying before, is where money is flowing, and money is flowing heavily from their perspective, and they get to see it because they get to see where the money goes, but into floating rate products.
Yep.
So everyone's looking for yield and they're looking for floating rate. So I thought that's interesting, and probably interesting to what we've been saying. We're adding a bit of duration back to portfolios.
Yep.
So duration, BetaShares is good to talk to understand where the money is flowing to.
Yeah.
So
I've got a book recommendation in that. I didn't meet the person, but
yeah.
maybe on LinkedIn, The Psychology of Money.
Oh, yeah?
I think I passed a copy on to you as well.
Yeah, I'm not a big reader. I downloaded the book. And,
Audible.
Listened to a little bit of it on the way between Melbourne and Newcastle when I was driving with Louis, my dog. So not quite through it yet.
It's like an Amazon. I think it covers, or they share a lot of their philosophies in terms of wealth creation or investing for retirement.
Yep.
To what we do. So great, but I think it's one of the top sellers on Amazon at the moment.
Sure.
And just kind of, brings out some of the most important things, which is even if you're in your 60s, you're still investing for a 30 to 40 year period. And a lot of investing is about not getting everything, it's not about getting everything right. It's about minimising your mistakes.
Yep.
Just something important that we always focus on.
Sure. Yeah, I mean, we argue that one of our values to clients is stop them making mistakes.
Yeah.
And, if you think about our day-to-day job, we do that a lot.
Right.
Yeah, so we caught up with BlackRock. That was good. Good recap on portfolio construction, asset allocation, and the tools that you can use to build portfolios. And it just re-emphasised our view that asset allocation and rebalancing is the most important tool within portfolio construction and adds the most value. If you then can overlay with a few tactical moves, overweights, underweights, then you can add enormous value versus picking the very best stock or the very worst stock. So.
Yeah, definitely. That's probably a good segue to our basic investment concept definition for the month, isn't it?
Yep.
We thought what's the easiest one is not the easiest one. One of the most kind of misunderstood is what's an index fund. We have a tendency to use jargon a lot in finance.
Beta. What's
beta?
beta?
Exactly. Beta is the market, is the average. So if you're talking about what's an index fund, it's a basic representation of what an entire share market or asset class is doing. So when you see the news every night and they say the ASX is up 1%,
yep,
that usually would represent the ASX 200, which is the 200 largest companies, sorted by size. With the bigger the company, the larger the allocation within that. And the vast majority of indexes are determined by the size or market cap of a company.
Yep. So an index fund is just an easy way to buy that representation.
Yeah, it's like there's a few good quotes about it that there's very few industries where you can get the average for free. Like medicine, you don't get average free, you don't get anything free. But you can buy the market for next to nothing.
Yep.
So I think...
when you say next to nothing, what does that mean?
So BlackRock
Yep.
charge, I think it's for the S&P 500, so the ASX 200 of US.
Yep.
I think it's 0.04%.
Okay. So basically nothing. A rounding error.
Exactly.
So you can get the market
Yep.
for free. Or we would say you can get beta for free or close to it.
And then probably the question that follows that is how does an active fund compare to an index fund?
Sure.
What's an active fund trying to do?
Yep. So an active fund, if the index is the combination by market capitalisation of those 200 stocks, if I'm an active manager managing on that index, I want to hold some stocks bigger position than the index, and I want to hold some stocks that are less than the index as a position.
With the intention of outperforming.
With the intention of doing better.
Yeah.
Doing better or reducing the volatility.
Yeah, both. That's probably the most important one. There are two objectives, not just one.
Yep. Do you want to recap? Returns return. That's pretty easy, right? If I put in $1, I get $1.15 back if it's done 15%. But volatility is now inching its way back into conversations about what is the vol, what does the vol look like. So what is vol, Drew?
I think smoothing, for the important part of that is when you're investing in retirement and you've got a finite amount of capital, you want to smooth the returns as much as possible, and you want to avoid periods of significant amounts of volatility, because that a lot of the time forces people to make emotional decisions. So volatility is a daily price movement or the movement in price of an asset.
So if that's that dollar, that's if that dollar goes down to 97 or goes up to 102.
Yeah, exactly.
Yeah, I assume clients don't really care if it goes up to 102. They don't call that vol.
They want it to
call it
110.
Return. It's just when it goes down. I mean, it's similar. It goes right back to, when we have a client, it's really important that we assess their risk profile.
Yeah.
But their risk profile is just the tolerance to see short-term losses.
Yeah.
So, you can build portfolios that are aggressive or conservative. That will affect the long-term returns, but it also affects the volatility, e.g. what the client will see on their statements each month in terms of potential portfolio loss, short-term portfolio losses. Now, the clients that are less tolerant to risk have a bigger reaction to when they see losses. So there is a trend in terms of understanding volatility, not just in portfolio construction, but in terms of each and every investment that you go into.
I think that's why we've always been keen on both active and passive.
Yep.
Because you can get the index for next to nothing, but it is the index. If it falls 30, you fall 30.
Yep.
And if you combine that with active at the same time, you can hopefully reduce that 30 to 10 or 5% or even positive in negative markets, depending on what type of investment it is. So how do you help clients or people listening to not make emotional decisions, and is to reduce the level of volatility across a portfolio?
Yep. And that index, so you can use index funds actively. Yep. So, e.g., market is horrendous like it was in 2008. I don't think it's there yet, but say in 2008, it's really easy to buy an index fund, but very hard to buy an active fund or a direct share
stock. Yep.
So therefore, using them or you might have already held index, it might have fallen 30. Are you selling some of your bonds to buy more at that negative 30 point?
Yeah, yeah, definitely. And what's the kind of closing out the two big topics of interest?
I like AI.
I know you keep sending me.
That's AI sending you stuff.
Send Drew emails.
I think that's a really big topic for 2023 and something that I want to learn a lot more about. We saw OpenAI that created Chat GPT, a chat program in December. Within 5 days, they had 1 million users. This week or just yesterday, it was announced that Microsoft is looking to do a deal with ChatGPT. I think value is $29 billion, so it's one of the most successful startups.
It's running for free at the moment.
It's running for free, yeah.
So there's no revenue.
Well, it's kind of a nice deal what Microsoft's proposed. So they put in $10 billion and they essentially get 75% of earnings until the $10 billion is paid back. But this concept that and you're a big one to talk about productivity, but if you use ChatGPT just for 5 minutes, you see the power. Well, I saw the power of it straight away and went, oh my, this is going to change a lot of things in the world. So what does AI mean to the world as a whole? How do I get exposure to it? How do I make sure our clients are exposed to it? So AI, I think, is a really big thing that we're focusing on.
Yeah. And I'll go negative. Property prices, which we probably called property down for 10 years until the more recent years. It was interest rate driven and valuation driven. We're always wary that interest rates would have to move higher, but we were 5 years 10 years.
But how do you recalculate the rental crisis? Because I saw a picture in mainstream publication.
It's a shortage of
on
property.
Weekend, 150 people lining up for a rental property in Sydney.
I was listening to a podcast about this recently, and they were talking about the fact that the central banks may actually be creating the rental crisis.
Yep.
So by increasing interest rates, you're actually decreasing affordability, so less people can afford to buy new homes.
Yep.
Plus construction slow down because it's getting too expensive to build.
Yep.
Leading to more people needing to rent.
Yep.
Maybe it's too short-term
Which means
focus.
property prices go up, right?
Exactly. Which is kind of reverse. And I think in the US, one of the biggest inputs into inflation is shelter, so rental. So it's kind of having this perverse, higher interest rates having a perverse impact on inflation itself.
Yeah.
But Australia's seen, is it nearing the biggest fall in 40 years in property, about 10 to 12% from the peak.
Yeah. I think the issue that we've always been worried about is the size of exposure that most investors have to residential property.
Yeah.
And if you tallied your whole net worth up into a balance sheet, as you probably should, essentially your return per year is going to be really influenced highly by what real estate does. So, that kind of concept of making sure there is a balance in exposures is still really important. So,
if you had to put a percentage on how much impact falling interest rates have had on property prices in the last, say, 10 years, what percentage of property increases were due to falling interest rates?
I think it's
More than
regional.
half?
I think it depends on where you are.
Yeah.
But, I would say that it's directly influenced, especially, let's call it the mortgage belt, where you could buy a property for, $300,000 or $400,000, which most families would have bought at one point, right? So house and land package in a new suburb. Now, the new suburbs 30 years ago were only 10Ks out, not 40Ks out.
Yeah.
But, what can you afford there? That was a multiple of income. And I think it was probably about average over that 30 years up to about 4 years ago, where you'd pay, say, $449,000 for a house and land package. Maybe it's on 400 squares, but you'd get a house and land, new suburb, grow up there, essentially. But now it's gone crazy, right? So that would have doubled, I think, in 4 or 5 years, all because of affordability. Husband and wife, new child, 26, 27, what can I afford? Go to the bank. The bank goes, you can afford $800 now.
Yeah.
They don't know any different, right?
Yeah.
So they buy the $800,000 house because they can afford it. The rate was 2.29 on a honeymoon for 3 years. Well, that's about to reset at mid-fives, and that's probably the worry. I don't know the percentages of how big that is in the property market.
Yeah.
Mainstream suburbs, we both live in the east in pretty nice suburbs. In my street, there's probably only, I'm probably the only one with a mortgage. So, higher rates is probably not going to affect those people. And those people, those people aren't going to sell the house because they've lost 10 or 15%. But and it's not going to affect their day-to-day because they own their house outright. So
I think there's a risk that it creates another shortage. So one of the drivers of property prices for like 30 years has been a lack of new supply in areas where people want to live. So if interest rates keep increasing and construction slows down, it's just going to exacerbate what's already a shortage, which should be good long-term for property.
The large construction companies have also started to slow down construction and development. So, I think that's the month of December and a bit of a recap on what 2022 was. So hopefully everyone's enjoyed what this is, and we're going to repeat it for the year. Feedback's welcome, of course.
Very welcome.
Yeah, good feedback. Thanks, Drew.
Appreciate the support, and thank you.